I am Dr. Laura Hendricks with the University of Arkansas System Division of Agriculture Cooperative Extension Service. Our topic for today is COVID-19 and your finances. And we talked about the three groups: reduced income and struggling, stable but anxious, and increased income with opportunities. And no matter which group consumers fall into, there are action steps that they can be taking at this time. We have with us as our guest presenter today, Dr. Barbara O'Neill. She is a PhD, CFP, AFC, and CRPC. And if you're not sure what those are, she is a certified financial planner, accredited financial counselor, chartered retirement planning counselor. And she's also the owner and CEO of Money Talk Financial Planning Solutions and Publications. She's a distinguished professor emeritus at Rutgers. She's past president of AFCPE and an AFCPE distinguished fellow and a next gen personal finance fellow. Here are a few of her numbers: 41 years of service as an extension educator, over 160 articles for academic publications, more than 35 national awards, and more than $1.2 million in grants. You can find Dr. Barbara O'Neill. Follow her on Twitter at Money Talk One. She has a weekly Money Talk blog on her website, and you can check out her latest book, Flipping a Switch. We've covered that in one of our webinars before too. It's the 35 strategies for transition after retirement. So please join me in welcoming today Dr. Barbara O'Neill.
So glad to be back here with Extension colleagues. Following your work from afar, and I attend as many of the webinars as I can myself and gain a lot from them. So I'm very happy to present this today. This was a presentation that I was originally asked to do by one of the continuing education units at Rutgers University for their employees. They had about 140 employees in their unit. Many of them were very stressed out about their finances. And I originally made the presentation back in December, and it's been pretty popular, and I've been doing it in several places. Okay, so let's get started. Just as a way of personal information and introduction, as Laura said, I've worked for Rutgers for 41 years and 4 months before I left at the end of 2019. And I've been a certified financial planner for 35 years, and now I'm a financial education entrepreneur. And just in case any of you are thinking about doing that in your post-extension life, it is possible. You need to lay a lot of groundwork when you're still working for cooperative extension, as far as building your brand and making contacts and the like. But it is possible to do that in case you're thinking about doing something similarly. So I'd like to start out with a question, and you can put the answers in the chat. How have you or a family member been impacted by COVID-19? So let's make it very personal and take a look at the impacts on your lives.
It's one response. Someone said her spouse lost a job, having family members take leave, or loss of wages, recovering from COVID. And in my family, we have several, we have a frontline healthcare worker and 2 essential workers. Son graduated from medical school with full-time job and residency, still working part-time in his field. Daughter lost work. Husband works in assisted living. Increased stress at work, increased demand for freezer beef, but lack of slaughter dates. Oh, interesting. Still working, but daughter lost her job. Working remotely since March. Many of us are in that. Daughter's business closed, a salon closed. Our work has changed to virtual, remote work. Struggle to balance remote work and family life. Some of the things: increased stress and health issues.
So it's fair to say that probably everyone on the webinar today has been impacted in one way or more, or a family member has, either personally, professionally, or both. And that's the reality that we've been living with in this country now for almost a year. It's hard to believe that we've been doing this COVID reaction now for almost a full year of our lives. The Wall Street Journal had an article some months back, which I thought was very interesting because I happened to read it right at the time that the book was coming out. And it mentioned that COVID-19 has been called a preview of later life. And there's the link for the article if you want to check it out. And the more I thought about it, I thought, wow, is that true? Many of the things that people experience when they leave the labor force are the same exact things people in this country have been experiencing with COVID-19. So just to kind of take it back to my book for a few slides here, these are some of the things that people have been adjusting to. First of all, people have had a changed income. Some people have benefited from COVID-19. Their income has gone up. Personally, I made double my revenue expectations for 2020, and many of the jobs that I picked up last year were as a result of COVID-19 because people who had digital content needed to build it out, and they need to build it out fast to transition to online education. So there are some people who benefited. Construction workers were another group that many of them were working overtime. But of course, many people lost income. So one way or the other, people's income changed. It went up or it went down. Many people, just like people who leave the workforce, had to create a paycheck. And notice it's kind of in air quotes because when you retire and leave the workforce, you're often patching together streams of income. If you're fortunate, you might have a pension, you might have Social Security, you might be working part-time, you might be drawing money out of your investments. So you have multiple streams of income. And many people, as a result of COVID-19, found themselves in the same situation. They had to find multiple streams of income. So maybe they had unemployment benefits. Maybe they had some severance pay. Maybe they too had to pull money out of their savings and investments or 401k accounts, things like that. Again, trying to create a paycheck to be able to cover living expenses. A third item that kind of isn't common is that just like many people as a result of COVID were reporting boredom and cabin fever, this is something that often older adults go to when they transition out of the workforce and they don't have a good plan for the use of their time. That can be a real problem. Many people reported too much togetherness, so when people are packed in and you've got kids trying to school at home and people trying to work at home and you're seeing your family 24/7 instead of maybe 12/7, there's a lot of togetherness there. And that's an issue that people often face in retirement as well when they're not working during the day. Some other issues that people face that are kind of in common with retirees, becoming fraud bait. So older adults are typically a big target for fraud because they have more wealth. Let's go where the money is, right? And also some of them kind of let their guard down a bit and become a little too trusting of people who might seem like they want to be their friend. And of course, we saw all sorts of frauds emerge as a result of COVID, and we still see them now. There's a lot of vaccine frauds out now as vaccines roll out. Another issue that's been reported, in fact, I was just scanning the Wall Street Journal today, and there was another article about the social isolation of young adults. And they were saying that, typically people think it's the older adults that are more isolated, and some are, of course, but they're finding, particularly with teenagers and 20-year-olds, that loss of social connection is really becoming a problem with their mental health. Another thing that people faced is disconnection from a team or a group, particularly people who work remotely. It's not like you're going to see each other face to face, and retirees often face that disconnection as well. And then people have had to make decisions about Social Security. So when people retire, they decide what age they want to collect benefits. But what we saw with COVID-19 is that it prompted many people to make decisions about Social Security earlier than they had planned. There are some people who were let go, older workers who maybe had planned to postpone Social Security a bit and ended up taking it earlier. I've often seen the result too, that people who had planned to leave the labor force have decided just to stay because there's just so much uncertainty now. They figured they better just stick with what they know, which is their job. So it can go both ways. Two other things that I didn't put on slides, but I'll also mention that are kind of commonalities between later life and COVID is healthcare transitions. I wrote in the book that when you leave the workforce, you've got 2,500 hours, extra hours. And that's a lot of free time. And certainly some of that can be spent on physical activity. In fact, there's a lot of research out there that suggests that in tough economic times, people actually have better physical health habits. They eat better, they work out more because they have more time. Um, the other thing that many people have had to do is transition their health insurance, just like retirees may go from a workforce plan to a Medicare and maybe a supplemental plan. Many people who lost their jobs and lost their health insurance have had to transition to something else, whether it's COBRA or an Affordable Care Act, healthcare.gov plans, something like that. And then another thing too that we've seen that's kind of a commonality is a desire for organization and simplification. People often want to do that as they get older, but of course many people wanted just to organize their workspaces. If they're at home 24/7, they wanted to have a little bit more organization and maybe simplification. Okay, so as Laura mentioned in the introduction, when you think about it, every American can fit in one of these categories. So think about yourself, think about the people you know, think about your clients. There is a big chunk of Americans who have lost income. They've had furloughs, they've lost jobs, and they're struggling. And then there's a second group who maybe have been able to maintain their income, so it's stable, but they're anxious. They're hearing rumors about layoffs, about furloughs, or they're looking at their emergency savings and saying, I don't have very much saved. So they're anxious just about all the things that are happening. And then you've got a third group that actually has either had increased income, as I mentioned with my situation personally last year, or possibly decreased expenses, or a combination of both. So they've freed up some cash flow and they have opportunities. So what I'm going to do is talk about strategies for each of these groups and kind of things that you might want to put in your toolkit as you're teaching and counseling people that fall into these different categories. But before we do that, let me talk a little bit about this concept of the K-shaped recovery. And what we mean by that is we need kind of a visual of how people are going to get out of this COVID-19, all of these impacts that we've seen. When COVID started, think back to last March, April, none of us thought that there would be 500,000 people who had died. None of us thought that this would be going on a year later. Everybody was predicting kind of a V-shaped recovery. So you go down, you go back up, and life is good, right? And we heard V-shaped recovery for a couple months. And then COVID lingered. And then we thought, okay, well, maybe it'll be a W. We'll go down once, we'll go back up. And then they were talking about going down again, when the cases went up during the summer months, and then we'll go back up again. So W. And then some people said, this is lasting a long time. So maybe it's going to be more like a U. We're going to have a big bottom, and then it'll go back up. And then we were into COVID for about 5 months or so, and people started to see all the disparities. They started to really look at the data, look at it by race, by gender, by occupation, and it became very clear that certain people and certain jobs were going to be okay. They're going to come out of this pretty much financially unscathed. And then there's a whole bunch of people who this is going to make their lives worse. And maybe they were pretty fragile to begin with. So hence the K graphic showing kind of the disparity in outcomes that people are experiencing. And again, there's an article in the Wall Street Journal. You can click on that link later and see the article in detail. So, like I said, what I'm going to do next is just talk about some action steps for each group of affected Americans by category. So, we'll start out by talking about everyone, though, because there's a couple of things that everyone needs to think about regardless of how they've been impacted personally. First of all, there's the urgency for estate planning. You know, if this is not a teachable moment for getting your estate plans in order, I don't know what is. I mean, we just passed 500,000 people dead in this country as a result of COVID. So major wake up call. And you may be getting some contact from clients, asking for programs and information about estate planning, because all of a sudden, these people may have gone from the pre-contemplating stage to the contemplation stage, and then they want to get into the preparation stage and figure out how they're going to do this and then take action. But keep in mind that because so many people have had this wake-up call, some attorneys may be backed up. So people may have to wait for an appointment to see an estate planning attorney. That may be the case in some areas of the country. It's also quite likely that the processes will have changed. You know, typically people would go into their lawyer's office, they'd have a sit down at a conference room table, and then they'd come back maybe a week later and sign the documents. And of course, with COVID protocols in some areas of the country, you might end up doing a appointment, just like many people are doing telemedicine. There's also telelawyering. So you may have that consultation with the lawyer through, Zoom or something. And then I've read of cases where the actual will signing, which typically involves the lawyer, two witnesses, which tend to be administrative assistants in the lawyer's office, and of course the person making the will. I've seen that being done here down in Florida in parking lots. Of course, we have better weather. They can do that more year round than other places, but they're figuring out different ways to do these things in a COVID safe manner. So don't be surprised if the process might take a little bit longer and be in a different way than it might typically be done. But of course, the key documents people need to think about would be having a will, a living will for their healthcare decisions, a durable power of attorney to name somebody who handles their finances if they're not able to do that. And it's also a good idea to just be thinking about having some other documents as well. So I have a couple links there to documents on the Rutgers Cooperative Extension website. We still maintain that website. I'm actually going back on the Rutgers payroll pretty soon to work for the continuing education people. So I'm keeping all the website materials online because I use them a lot in my work anyway. So we've got the beneficiary designation worksheet that's available where people can write down in one place on one piece of paper who their beneficiary designations are, for their life insurance, for their retirement savings plans like IRAs, 401ks, things like that. Have it all in one place and review it. That is something people should be doing. Also, a digital assets worksheet. We have one of those as well. And it's a good idea for people to have those in place too, because COVID can happen and people may be incapacitated. Somebody may need to access bank accounts or access any information, and they need to have this information in a readily available format. So everybody needs to be doing some estate planning regardless of which of the three categories they're in. The other thing that will kind of impact people in different ways, depending on how the changes in their income have been, is the income tax implications. So, of course, the recovery rebates, and I know you just had a webinar with Andrew last month that talked about income taxes. And as he mentioned on that webinar, everything's going to get settled up on your tax return for 2020. So this is where people, if their income has gone down in 2020 from what it was in 2018 or 2019, whichever year or both years were used to calculate their payments, they might actually get more money. So it's all going to get settled up on your tax return. So everybody will be doing that. Not everybody will get a rebate because, of course, it's income based. There's going to be tax on unemployment benefits. Hopefully people won't get cut short on this, where they're going to have to scrape up money by April 15th. I know some states took out money as a payroll deduction, so they had withholding on their unemployment. But if people didn't, hopefully they've been setting money aside for the tax liability on those payments. And that includes both their state unemployment benefits that they wouldn't have gotten normally, as well as that extra $600, and then it was $300 that came from the federal government. Everyone on their 2020 taxes can deduct up to $300 of charitable donations if they don't itemize, and about 90% of people don't itemize anymore, so that's a little bit of a tax benefit there. Another thing to think about is that people who may never have been eligible before for certain tax credits because their income was too high may qualify in 2020 on their taxes because they've had a loss of income. So things like the earned income tax credit, the savers credit, they may be available to people for the first time. And then, of course, we had under the CARES Act the waiver of the 10% early withdrawal penalty on retirement accounts over 3 years. And so that was a change. RMD suspensions were another big change. I talked to several people here in my community. I live in a 55 plus community here in Florida, and they're all talking about the fact that maybe they'll even get a refund this year or a big one because they suspended their RMDs for the year and then didn't have as high an income to be taxed for 2020. And then another issue for some people could be if they left their home state to do their work or remote work, they could be facing a state tax liability in their non-resident state as well as their resident state. So that's something they'll have to check. It depends on the state, what their laws are, what kind of reciprocity they have with other states, but it might be something for people to check into if they've gone somewhere else to work to ride out the pandemic. And then I think the other thing that everybody needs to have is a budget or a spending plan. Again, whether your income has gone up or it's gone down, it's changed. So when things change, you want to update the documents to reflect that. So there's a tool on our Rutgers Cooperative Extension website. It's called the Spending Plan Worksheet. That's a tool that people can download and use. And basically what you're doing, of course, is projecting your future income and expenses. Another tool that I really like, and this would be particularly useful for people who are struggling and have a limited income and are trying to stretch it as far as they can, is the bill payment calendar. And this is from CFPB. And I think it's just a great tool because on one page, you can write down what the bills are and then put them into the calendar, and you can see ahead where you have to have income and what bills are due and when they're due. So it's a good resource. And the other thing people might want to do is change their bill payment date. If they're finding that all their bills are kind of clumped together in one part of the month, they may be able to just pick up the phone, call their utility company, for example, and get their bill payment changed, the date changed, so that they can kind of spread out their bills a little bit more and not have them all come due at the same time. Okay, so those are some things that everybody should be doing. So once again, we're talking about estate planning, we're talking about tax planning, depending on how COVID affected you, and then we're talking about preparing a budget. Okay, so let's talk now about the group that we're most concerned about in the country, and people who many of them are probably contacting you for assistance, either through educational programs or one-on-one counseling. This is the group that has experienced COVID-19 as a financial trauma. So they've lost income. They're experiencing food insecurity. They're depleting savings. If they had savings, it's been wiped out. Or maybe they didn't have savings, and that's even worse. They've been experiencing, a constant on and off of moratoriums and delays. Now, they just reported in the Wall Street Journal the other day, they had an article. I actually had two articles, one that was from last week and one that's this week. And the earlier one was talking about all these leniency provisions were going to run out. And now apparently they have extended the mortgage relief through June 30th. So people have a little bit more breathing room. But they've been dealing with this for a year, with all these deadlines that keep moving. And how much stress is that, thinking that you're going to have somebody knock at your door and, evict you or kick you out of your house, foreclose on you. And it's kind of been hanging over people's head for a year. Eviction proceedings. And again, some of this has been dependent on the type of mortgage that the landlord has, and some of it is like city specific. So there's been all sorts of rules depending on where people live about evictions. And then many people have had benefit access issues. I remember down here in Florida, they had all sorts of problems with the unemployment system as people started to lose jobs. I mean, some big companies like Disney here actually kind of ran their own system to get their people on unemployment because the state system was just having so many issues. And then another big issue, not to be discounted for people in all groups, but it's particularly hard for people who've reduced income and struggling, is the inability to access social support systems. Like parents, like grandparents, with all the quarantines, with all the uncertainties about travel. I mean, there was a really good article in the Wall Street Journal last week about how grandparents are stepping up to take care of their grandchildren so that their children can work from home. So there were some good stories like that, but in some cases, people just haven't been able to do that just because of issues related to COVID and fear of contracting the virus and that sort of thing. Okay, so those are all the issues that people are dealing with. So what do you do? Well, it's basic personal finance, and it really comes down to prioritizing. If people don't have enough income to pay every bill that they have coming due, they set priorities. And we basically have three categories of expenses. Typically we've always talked about needs and wants, but there's actually three groups. There's needs, obligations, and wants. So your needs obviously are things that we need for survival. So most people would put into this category food, obviously, that would be the number one need. Rent or mortgage payments, utilities, co-pays for medications so that you can keep medications flowing if you need them. Basic utilities like phone and internet, just because they're so critical, almost as a lifeline these days. And then health insurance. Those would probably be what most people would consider needs. And then you've got obligations, and I'll get to them on the next slide because you can actually prioritize different obligations. So these are things that you're kind of on the hook for. But again, you have to think about, okay, what's the worst thing that can happen if I can't pay this bill? And then, of course, wants is everything else. So they're not needed to survive. You have no obligation to pay them, things that we would kind of think about as being flexible or discretionary expenses. So I took a webinar early in 2020. I think it was back around April or May of last year. And it was by a credit counseling agency in New York City. And it was a webinar that they did for the New York Public Library. And they took the obligations and put them in this sequence. Personally, I think, if you wanted to move something from 5 to 4, I don't think this is set in stone, but it gives you kind of an idea of how people might prioritize the obligations that they have. And again, it goes back to that question, what's the worst thing that can happen to you if you don't pay this expense? So court fines and fees, that's pretty much a priority. I mean, you don't want to be on the receiving end of fines and fees and have them accumulate. And if you're dealing with the court system, you don't know what else is going to happen. So that's a priority. Obviously, child support is a priority. It's a priority not only legally, but also many people would think morally as well, to support your children. And then insurance premiums, people want to keep them in force. So you might have auto insurance. You may have some type of property insurance, renters or homeowners, life insurance, disability insurance. Again, wanting to keep all of those in force. Different judgments that people might have against them, secured debts, because obviously if it's secured, there's collateral that can be taken away if you don't make those payments. Taxes and tax debt, because again, IRS, you're dealing with them. They have the power to, levy on bank accounts and put liens on property. But the one thing that the IRS also has is a number of avenues where people who are in financial distress can seek a way to pay their taxes off in a gradual basis. So that's why taxes isn't number one, because you can work with the IRS a whole lot easier than you might be able to work with somebody who's charged you a fine or a fee. Then you've got student loans. And fortunately, there have been a number of moratoriums on student loans anyway under the CARES Act. Your unsecured debts, like credit card bills, things like that. Probably the last thing on the list might be interpersonal debt, like owing a family member, hoping that they would cut you some slack if times were tough. And then there may be some others that you can think of as well. So this kind of gives you kind of a hierarchy, if you will, of the obligations that people might need to pay and the order that they might pay them in. Some other tips for Group 1, I'm sure many of you are familiar with your local 211, but they are a great resource for finding out about services in your community. I used to make lots of referrals when I was a county extension educator to our local 211. So it's kind of like 911, like you would call 911 if you were in an accident or something. You call 211 if you want to get connected to resources in the community. So that could be food pantries, utility assistance, things like that. This is a good time for people to eliminate any subscription services that they might have that are automatically debiting their bank account or their credit card bill. And in fact, many of these things we may not be using anyway, because a lot of people aren't going to gyms anymore because they may not exactly be the safest place to go during a pandemic. Maybe cutting back on some streaming services. If people have multiples, maybe just keep one instead of 3. Again, people have to look at their own situation. And then also to assess the resources that they do have. Their emergency fund, possibly cash value life insurance, possibly retirement savings. Hopefully people don't have to tap that, but some have had to do that. Taking a look at all the CARES Act leniency provisions, but right now the CARES Act is so old. I mean, it's 11 months old now. So I guess what you really need to be looking at now is all the extensions that took place. And some of them took place under the Trump administration. There's more of them now that are taking place under the Biden administration, because when they passed the CARES Act, like I said before, nobody thought that it was going to be, a year later, and we're still dealing with this. So a lot of these CARES Act provisions have technically expired from when the law was passed, but then they've been extended through presidential, memos and, different ways that they've extended these. Of course, you want to stay insured. That's important for people in every group. And of course, trying to do everything you can to protect your credit. And I think you're all aware that up until the end of April, people can access their credit report weekly if they want to, just to make sure that there aren't any dings on their credit history related to things that might be provided for under the CARES Act. Okay, so those are some tips for group one. For group two, who have the stable income plus anxious, they haven't lost any income yet, but maybe there's some ominous warning signs, about their employer and the stability. Maybe things look kind of rosy a few months ago, but they still haven't turned around yet. And a good example of that is the tourism industry and airlines. There was just an article in the journal the other day talking about how it's not going to be a good 21 for that industry because people just aren't comfortable yet. They're not vaccinated yet, and they're not comfortable yet. So people who maybe thought they would be okay, there may still be some layoffs or furloughs to come. And this is also a group that may be hearing the stories of the challenges of family and friends, like many of you wrote about in the chat, and also worried that emergency savings is inadequate or debt is too high. So what do people do in this situation? Well, you can develop a furlough preparation plan. And I remember writing about this first when I worked for Rutgers Co-op Extension in 2008 when we had the Great Recession, and there were a lot of furloughs at that time as well. And it really comes down to figuring out what is the value of a day's pay? What do you earn in a day? So you can figure that out pretty easily just looking at your net income on your paycheck and, figuring out, is it weekly, biweekly, and figure out what a day's pay is. And with some of the furlough schemes, there's a number. They're going to say, okay, over the course of X months, you have to take Y number of days of furlough. So you can actually mathematically kind of prepare for it by knowing, just multiplying X days times the value of a day's worth of pay, and what your income loss is going to be. Obviously, anything people can do to increase their emergency fund. Of course, they're promoting this big time this week because of America Saves Week. And one of the things that, I just always suggest during America Saves Week is just think about doing the 30-day $100 savings challenge. And at the end of the month, you have $100. If you do it every month, you have $1,200. If you could scale it up to $300 a month, you have $3,600. And if you can do $500 a month, you've got $6,000 in a year. So it gives you the structure, and it gives you kind of a goal to shoot for. So obviously, if you think your job is iffy, you want to increase as much savings as you possibly can, and also try to get out of debt as fast as you can using PowerPay. And another thing people in this group might want to think about, any group really, but particularly this group where they're concerned about their jobs, is human capital investments, whether it's courses, certifications, degree programs, anything that they can do to build up their skills, knowledge, and experience, possibly starting a side hustle on the side. Again, you have to be in sync with all the rules that your employer may have as far as having outside employment, but that can provide at least a backup, additional income, and then a backup source of income should you lose your job. Refinancing, if people haven't done that, and also making sure that their investment portfolio is rebalanced and keeping that where they want it to be. Okay, and then there's the third group. These are the people who have increased income, or maybe they've decreased their expenses as well because travel and entertainment are kind of off the table, and they have opportunities. So these are the people that I see for the most part in my neighborhood in Florida. So my neighbors across the street are the ones that have the tall palm trees, and that's my bird cage on the back of my house there. And these are people who've experienced little or no asset value loss. Obviously the stock market hiccups when it does, and we saw that big drop, about a year ago when COVID first came on the seen. But for the most part, these are people who've had increased income and or cash flow. They've decreased their expenses in many cases because you've got people who are working from home. They're not commuting the way they would have. They don't have the child care to pay for. That doesn't mean they don't have child care because they're probably doing it themselves at home, but they don't necessarily pay a child care provider because they're working at home. And they're saving on meals eaten out because they're working from home. So their expenses have decreased, plus all the discretionary expenses they wouldn't be making either. So many people have been spending freely on home improvements. In fact, there was an article in the journal yesterday that talked about the fact that the construction industry and manufacturing, they went into their recession playbook. And the recession playbook says that when you're in a recession, you cut back on production and you lay off workers. And what they didn't anticipate is with COVID, there's a group of people that have increased income and they have money to burn and they want to substitute the money that they would have spent on travel and entertainment for, home improvements, and the warehouses can't keep up. So there's just so many backlogs now for people who are ordering things. And of course, if you think about a lot of things coming from overseas, particularly China and supply chain issues, that's kind of making it worse too. So these people are spending freely. They have lots of opportunities. However, that doesn't mean that they don't have impacts. Some of the things that I've been seeing around my neighborhood, a lot of boredom, a lot of fear, a lot of survivor's guilt. Why do I have it so good when so many other people are suffering? Anger about the lost opportunities. People around here don't talk about losing 2 years of their life. They talk about losing 2 good years of their life because they're acknowledging that they're getting older and, a prime year that they could have traveled or done something has passed them by. And then, of course, the mental health issues that I mentioned before as well. So some of the tips for this group, in addition to all the tips that I mentioned for the others, are obviously to take advantage of this positive cash flow and save and invest it, make prudent home improvements that have a high return on investment, typically, kitchen remodels, bathroom remodels. Down here in Florida, it's bird cages on the back of your patio, whatever it happens to be where you live. Be careful about requests for co-signing loans and long-term support of adult children. I've actually talked to some neighbors too that are kind of in that story right now because their kids they're struggling and they're having to, take home children. So it's funny, I live in this 55 plus community, but there are some days I walk around, I think I'm still at Rutgers because we have a lot of 20 and 30-year-olds that have come home to live with their parents. Getting serious about philanthropy, we'll talk about that in a minute, and also making sure that if you do have increased income, that you're withholding appropriately to have taxes paid on that income. So I thought I'd just put in a few slides from another presentation that I have on making tax-advantaged charitable donations, because people in that third group may be inclined to do some additional philanthropy and be looking for some ideas. So there's different ways that people can give to people or charities. You can make outright gifts, cash, securities, untitled property, who gets grandma's pie plate kind of stuff. You can name people on your retirement accounts as beneficiaries. Same thing for life insurance and annuities. And again, there's that worksheet that I talked about before from Rutgers where people can list those all in one place. And of course, people can also make bequests via their will or a trust. And then there's also ways that people can make tax-advantaged gifts during their lifetime. So again, these people who have this extra income and cash flow may be thinking about some of these strategies. One thing you can do is you can bunch up your itemized deductions into 1 year. Typically these days, the only way people are going to be able to itemize deductions now, that 10% or so, is with some type of planning. So bunching up is a type of planning where you say, okay, I'm going to make a big charitable contribution maybe every fifth year or something like that. And you bunch it all up and you add it in with your property taxes and your income tax, and you able to get over the standard deduction and you itemize. So that's what they call bunching up. Some people will donate appreciated securities. So rather than take the capital gain on stock that has appreciated or mutual fund shares, they donate the securities, and the charity gets the donation and they don't have that extra income from that capital gain. People who are older, 70 and a half or older, can take what they call QCDs, qualified charitable distributions, from their traditional IRA, have that money sent directly to the charity from the custodian. And that way it satisfies their required minimum distribution requirement for their withdrawal, and it also helps the charity. Another thing that people can do, and I did last year, is to set up what they call a donor advised fund. And this is a fund that you set up with a custodian. You know, Schwab has them, Fidelity, Vanguard, TIAA, all the major investment firms have them. And you make a lump sum deposit. Typically, you'll want it to be higher than the standard deduction, otherwise, why bother? And you set it up with the custodian. The money becomes, it's not your money anymore. It is now the property of the donor advised fund. So it's almost like setting up a trust in a lot of ways, because the money then becomes part of the donor advised fund. And then you're able to make donations. They call them grant requests. And you literally just go online. I use Fidelity. And I just go into Fidelity Charitable, and if I want to make a donation, let's say to AFCPE, like I did last fall for the mini grant, I just went into, Fidelity Charitable, put in some information about AFCPE, and then the custodian sends the check to the charity, so you don't get involved as all. And you get to choose your asset allocation on your donor advised fund. So last year when I set it up, of course, the stock market did very well. So the fund actually ended up at the end of the year with $5,000 more than what I had put into it originally, which is great, because it's great for the charities that I'll donate to. And it's great for me because it's like extra money that I'm able to donate that I didn't even put in myself. So many people are setting up donor advised funds. Also, if people want to go a step further, they can meet with a lawyer and set up what they call a charitable trust. There's charitable lead trust, there's charitable remainder trust, and again, all the assets that you put into the trust would have to be titled in the name of the trust. Just a little bit about non-itemizing taxpayers, like Andrew mentioned in his webinar. We do have, for 2020, it's $300 whether you're single or married filing jointly. But for 2021, as a result of the law that was signed at the end of 2020, which has that big, long, convoluted name there, it'll actually be $600 for married couples for your 2021 taxes that you'll file next spring in 2022. And this is for cash contributions only, so it's not dropping stuff off at the thrift shop. It's cash, and you put it on the 1040 form, and it does not include donations for the donor advised fund, because you would have already gotten the tax benefit by creating the donor advised fund, so you can't kind of like double dip there. And then for the itemizing taxpayers, this is really a great year to think about making a large charitable gift, because as a result of that law that I just mentioned, there's no cap on the amount of donations that people can make in 2021. Usually it's 60% of adjusted gross income. But for this year only, because of coronavirus relief, they've temporarily suspended that limit. And as always, you're required to have a record of your charitable contributions over $250. And typically the charity would send a letter that would document that you made that contribution, and also the fact that you didn't receive anything from them in return for that contribution. The one thing the IRS did do, however, though, when they took off the cap for this year, they raised the penalty. So if anybody gets caught overstating their deductible donations, they've raised the penalty from 20% to 50% of the underpayment. So big tax penalty there. So obviously they want to keep people in compliance. And this is the section of the tax form where you would either be putting your charitable contributions. If you take the standard deduction, that would be 10B, or if you had itemized deductions and charitable contributions were part of that, you would put that on line 12 and use your Schedule A for your itemized deductions. Okay, so just some final thoughts as we wrap up here. You know, things can really seem out of control for a lot of people. And I guess the biggest thing is just the uncertainty of it all. You know, when people are going to get their jobs back, when we're going to get herd immunity, and uncertainty just triggers so much stress in a lot of people. So we have to think about, okay, what are the things we can control? You know, we can control all the healthcare measures that they're still telling us that we should do. The hand washing, the distancing, the mask wearing. We can control if we decide to have physical activity every day, and hopefully everybody is doing that. Checking in with friends and family. You may not be able to see them, but that doesn't mean you can't Zoom with them or call them. We can control our outlook, our attitude, our emotions, our saving, our spending, and our giving. Those are all things that we can control. And then one thing that is something we all have to do is learn to accept uncertainty, because we've had a lot of it and we're certainly going to have more of it. I was on a webinar with University of Florida Extension some while back, and they were just talking about ambiguity and the fact that people just have to get comfortable being uncomfortable. And that's really hard to do, particularly people who, like me, tend to be kind of like control freaks and we want to control everything. And it's just not possible to do that sometimes. One of the things they said in that webinar is to try to identify your uncertainty triggers, you know, the things that really stress you out about all the uncertainty that's taking place right now. And for many people, it's social media, anxious family members, particularly children. You know, why can't we go somewhere? You know, when is this going to be over? That kind of thing. Lack of sleep is another one. And again, just practicing being comfortable, being uncomfortable, focusing on the present, all the mindfulness principles, managing stress, anxiety. So some tips there. And then another speaker that I heard said that maybe if you're feeling really stressed out, make 3 columns on a sheet of paper, and one of them is control, adapt, and monitor. You know, write down all the things you can control, all the things you can adapt to, and all the things you need to monitor. And monitoring might be something like, you know, finding out when the vaccine is going to be available and where you have to go to get it, those kinds of things. Okay, and then there's one more challenge that I think we need to think about personally and also think about helping our clients with. We've been living with this for almost a year now, and Americans have developed a quarantine state of mind. You know, it's been on the news every day, you know, for a year. We've been living with all the healthcare, you know, recommendations and the changes in our lives. Many people have kind of gone into limbo. You know, if you're really struggling, you're in survival mode. Others have been what's been called stuck in a rutness. And I think Karen Reichel a couple months ago, he did a webinar on financial numbness. So whatever you call it, a lot of people have been in a holding pattern. I mean, that's one of the reasons why our housing market, you know, they're having bidding wars all over the place, is all these would-be sellers have been in a holding pattern. They just don't want to sell their house and have to go through moving in the middle of a pandemic. So people have been putting off all sorts of decisions for the past year just because of COVID. You know, the uncertainty, they just don't want to do anything in the middle of a pandemic. So one of the things that we're going to need to do is just to help people feel comfortable making plans again. Because so many people had their plans blow up last year, whether they were travel plans or new job plans. I mean, one of my neighbors across the street, her 20-year-old did a virtual college graduation, had a job offer, and 2 days before he was supposed to get the job, they rescinded the offer. People have had their lives blow up. So, it's not surprising people haven't wanted to make any plans, because why make plans? They're just going to blow up. We don't know what's going to happen. People are going to have to feel comfortable learning how to make plans again, and then taking action on those plans and moving forward. And also taking advantage of opportunities and getting out there again, if it's changes in their career perhaps, or moving plans or whatever. And most people are predicting that we're never going to go back to exactly the way we are. What we're going to do is, this is our pre-COVID life, this is our quarantine life. We will end up somewhere here in the middle. So in the chat, I put in the link for my blog post this week that I wrote about this in my blog, and some of the things that people will need to think about as we exit COVID at some point in time. I wanted to also share some resources that are out there that are really good. The Wellness Society has the Coronavirus Anxiety Workbook. The Center for Financial Social Work has this really good financial reality coping ebook that you can download. Again, my blog, I've been doing a lot of posts about COVID. And then the New York Times also developed a place where they're kind of putting all their coronavirus items, and they don't have a paywall as they normally do with their other articles, because it's related to COVID-19. So I've thrown a lot at you, and as you all know, I'm a Jersey girl, and I'll always be. I call myself Jersey girl in the Florida world. And if you've ever been to New Jersey, it's kind of famous for its diners, and the menus are really thick. So you walk into a Jersey diner, like a few of them that are pictured here, and you can't possibly eat everything on the menu. So it's kind of the same thing with this webinar. I've thrown a lot of ideas at you. Some of them will work for some people and not for others. Some of them work for you and not for others. So just pick and choose off the diner menu the tips and the strategies that might work for you and your clients. Okay, so I'll end it up there, Laura, and just see if there's any questions or comments that people have.